Passive investing. Passive investing aims to replicate the performance of a specific market index. One primary method of passive investing is through index funds, which are designed to mirror the performance of a particular index by investing in the same basket of stocks in the same proportions. ETFs are very low cost, as there is minimal trading and management involved. This approach is often referred to as laid-back investing because it does not require constant monitoring and decision-making. Even top active investors like Warren Buffett advocate for passive investing for the average person as a straightforward and effective way to achieve long-term growth. Active investing. Active investing is a strategy where the investor or a professional fund manager actively makes decisions about buying and selling, seeking to outperform the market through strategic moves and research-driven decisions. This strategy encompasses various approaches and offers the potential for higher returns, flexibility to make quick adjustments, and risk management to move out of volatile sectors or hedge against potential losses. However, active investing also comes with challenges such as higher costs, being time-consuming, the risk of underperformance, and complexity. Fundamental investing. Fundamental analysis is used to evaluate the intrinsic value of a company by examining related economic, financial, and qualitative factors. Analysts then compare this to the market and determine if an asset is undervalued, fairly priced, or overvalued. Concepts used in fundamental analysis include financial statement analysis, qualitative analysis, and financial ratios and discounted cash flows to determine value. Value investing. Value investing involves calculating the intrinsic value of a business and then buying it at a significant discount to that value. Value investors look for stocks that are undervalued due to negative market sentiment or temporary setbacks from which the company will recover, with financial health frequently being a top priority. Margin of safety is a central concept in value investing. This is the difference between the intrinsic value of a business and its market price. By purchasing stocks with a significant margin of safety, investors protect themselves against misjudgments in valuation and unexpected adverse events, minimizing potential losses. Value investors aim to avoid value traps, which are stocks that appear to be a great deal but may never recover. Quality investing. Quality investing focuses on buying companies of high quality, characterized by robust growth prospects, consistent earnings, and strong financial health. Quality investors seek businesses with sustainable competitive advantages or barriers to entry, such as high switching costs, network effect, proprietary technology, or economies of scale. A strong moat protects the company from competition, allowing it to maintain extended periods of above-average returns. Quality investors also consider management quality, and they look for effective management teams that allocate capital efficiently and return excess cash to shareholders. One downside to this strategy is that assessing quality involves subjective judgment, and that is prone to bias and errors. Another risk is that high-quality companies often trade at premium valuations, and overpaying for these stocks can lead to suboptimal returns. Growth investing. Growth investing focuses on identifying and investing in companies that exhibit potential for substantial future growth. These companies are often found at the earlier stages of their development. They might have a large total addressable market and significant potential to grow by capturing a larger share of the pie. They might also have created entirely new product categories or industries. By understanding where the future is headed, growth investors can forecast the growth trajectory for these companies. One risk of growth investing is that at this early stage, growth companies frequently spend substantial amounts of money to start or scale their business. They do not have long histories of financial performance. All these make their future growth prospects more speculative. Thematic investing. Thematic investing focuses on specific areas of innovation that are expected to bring significant changes to the world. A thematic fund might focus on one particular theme and include a basket of companies involved in various aspects of that theme. Similar to growth investing, thematic investing involves understanding the future direction of technological advancements and societal changes and aims to be invested in the right themes early as these trends unfold and shape the future. The downside to thematic investing is that each fund is focused on a specific area of the market, leading to a concentration risk. If the chosen theme underperforms, the entire fund can suffer significant losses. Momentum investing. Momentum investing is based on the idea that assets showing upward price trends will continue to rise, and those showing downward trends will continue to fall. Investors use tools such as moving averages and relative strength to identify and confirm these trends. They typically hold positions for a short period of time and regularly rebalance to buy into new trends or sell out of played-out ones. Zooming out, momentum investing is partly based on the principles of behavioral finance, which suggests that investors often follow trends due to herd behavior, overreaction, and underreaction to news and events. A downside to this strategy is that accurately timing entry and exit points can be challenging. Sudden trend reversals can also occur due to unexpected news, market corrections, or changes in investor sentiment. In such scenarios, if positions are not exited promptly, an investor might experience significant losses. Emerging market investing. Emerging market investing involves putting capital into countries and regions that are in the early stages of economic development and industrialization. This contrasts with developed markets like the US, Europe, and Japan. Emerging markets in regions such as Latin America, Asia, and Africa typically have younger populations and are actively building physical, digital, and healthcare infrastructure. They often exhibit higher economic growth rates due to their developing nature and potential. To invest in these regions, due diligence is crucial. This is because rule of law and corporate governance are still evolving here. To reduce this risk, investors often adopt a boots-on-the-ground approach and conduct on-site visits and assessments to validate business operations and gauge the local economic environment. Small cap investing. Small cap investing refers to investing in companies with market capitalizations generally below $2 billion. These stocks offer significant growth opportunities due to their smaller size and higher growth rates compared to larger, more established companies. The opportunity here lies in that small cap stocks are less covered by analysts and media, and therefore the market has not yet priced in everything about them. Diligent investors in small caps can potentially identify undervalued gems. A downside to this strategy is that in industries where larger companies dominate and benefit from economies of scale, stronger brand recognition, and greater resources, there might be a winner-takes-all scenario. In such situations, smaller companies might struggle. Sector rotation. Sector rotation involves shifting investments between different sectors of the economy based on the stage of the economic cycle. As the economy moves through different stages of the cycle, the leadership among sectors changes and investors strategically rotate between sectors. Investors use economic indicators such as GDP growth, interest rates, inflation, and employment data or perform analysis of trends, sector fundamentals, and historical performance to make their forecast. Successfully implementing a sector rotation strategy requires knowing where one is in the cycle and timing entry and exits accurately. But economic indicators and market trends can be unpredictable, making it challenging to forecast accurately. Unexpected events can also disrupt anticipated cycles and sector leadership. Asset allocation. Asset allocation involves actively adjusting and optimizing the allocation of assets to achieve the best possible returns while managing risk. This strategy involves diversifying investments across various asset classes, each with distinct risk and return characteristics. There are two types of asset allocation: strategic and tactical. Strategic asset allocation is long-term and based on an investor's risk tolerance, investment objectives, and time horizon. Tactical asset allocation involves deviating from the strategic allocation to capitalize on short to medium-term opportunities or to protect against anticipated risks. Similar to sector rotation, investors use decision-making inputs like economic indicators, market analysis, and risk assessment. Technical analysis. Technical analysis evaluates and predicts future price movements of securities based on historical price and volume data. Analysts use different price charts like line, bar, and candlestick to identify patterns. They also conduct trend analysis to identify upward, downward, or sideways trends. Typical patterns include head and shoulders, triangles, double tops, and double bottoms. One of the risks to technical analysis is that short-term price movements can be noisy and misleading, making it challenging to distinguish between significant trends and random fluctuations. There is also an emphasis on short-term movements, which can result in frequent trading, higher transaction costs, and tax implications. These erode overall returns. Shorting. Shorting is where an investor bets that the price of a stock will decline. A short seller borrows stock from a lender, sells the stock on the market at the current price, point A, and receives cash. After the stock price declines, point B, the short seller buys back the stock at the lower price, returns the borrowed stock to the lender, and keeps the excess cash as profit. Shorting is frequently used in hedging strategies to manage risk, with the idea that if one investment goes down, the loss is offset by gains in another investment, allowing investors to still make money on the whole. However, shorting is risky. If the stock price increases rather than declines, the short seller faces potentially unlimited losses, as they must buy back the stock at a higher price, in an event called short squeeze. Market-neutral strategies. Market-neutral strategies are designed to eliminate or reduce market risk by taking both long and short positions. The goal is to generate returns that are independent of the overall market's movements. Different long-short strategies include long company short market, which isolates company performance, long company short sector, which hedges sector risk, and long company short competitor, which profits from relative performance. Other strategies like price arbitrage can exploit price discrepancies in different markets, for example. This aims to minimize market risk and generate risk-free returns. Event-driven. Event-driven strategies seek to capitalize on price movements resulting from specific corporate events or significant occurrences that impact a company's stock price. These events may include mergers and acquisitions, earnings announcements, corporate restructurings, regulatory changes, or special situations like lawsuits or management changes. One specific event-driven strategy is merger arbitrage. This involves evaluating the likelihood of a merger or acquisition being completed and taking positions to profit from the difference between the current market price and the acquisition price. Another strategy is activist investing, and this involves buying stakes in companies to influence management decisions and drive changes believed to unlock shareholder value. ESG investing. There are generally three types of ESG investing: exclusion, integration, and impact. Exclusion involves excluding sectors or companies deemed harmful or unethical, often based on values or religious beliefs. Integration considers ESG factors as part of the fundamental analysis of a company and assesses material risks and opportunities related to the environment, social practices, and governance. Impact investing focuses on either investing in companies that are actively making positive social or environmental change and measuring their impact, or engaging with invested companies to influence their practices through collaborative efforts, engagements, and/or shareholder proposals. A key risk with ESG investing is greenwashing, where companies or funds portray themselves as more responsible than they are, misleading investors or clients. Dividend investing. Dividend investing focuses on purchasing stocks of companies that pay out a steady dividend. This is particularly beneficial for retirees. There are two types of dividend strategies: dividend growth and dividend income. Dividend growth strategies focus on companies that consistently increase their dividend payments over time, while dividend income strategies target companies that offer high dividend yields today without much concern for growth. Dividend-paying companies are generally more mature, with stable earnings and strong cash flows, and do not need to reinvest all profits into the business, thus returning a portion of excess cash to shareholders. A particular task for dividend growth companies is to strike a balance between paying dividend and growing the company.